Hello, everyone. My name is Pieter and I welcome you to the PwC Tax Bite podcast series. In this episode, I'm very happy that I have Evi Geerts and Jori Gikier in my virtual recording studio. The reason for this episode is very simple. The OECD has published a new batch of documents regarding Pillar 2, and that is enough to talk about in this podcast. So today we're going to talk about the publication that happened early in January of a new batch of additional guidance. And as I said, I have Joni and Evi with me. And maybe Joni, as a starting question, just for the audience, what was exactly published by the OECD recently?
Yes, Peter. So the OECD indeed released a new batch of documents. And for me, there are basically three different blocks in which those documents could be categorized. First one being the central record of legislation with transitional qualified status. So basically the list of jurisdictions that have a qualifying legislation implemented. The second block is new administrative guidance. This administrative guidance relates to Article 9.1 of the Globe Model Rules. It's about the tax attributes upon transition. And then the third block relates to that Globe information return. So we received a new updated version of the template Globe information return and as well a multilateral competent authority agreement. So a lot of information again to digest.
Yeah, thanks, Joni. So, yeah, 4 building blocks there. Now, the OECD has a tendency of publishing a lot of guidance. We have seen that since the official publication of the model rules. We have seen approximately every 6 months or so a publication of new guidance. So, let's use your 4 blocks, I think, as a bit of a structure for a podcast and tackle them maybe one by one. I think the additional guidance is something that a lot of taxpayers are asking me about. So it is about deferred taxes, Joni, and it could have a big impact. So maybe can we start with that one? And can you elaborate a little bit on what's in the package?
Yes, absolutely, Peter. So as I mentioned, Article 9.1 is about tax attributes upon transition. So that article basically determines which deferred tax assets, deferred tax liabilities that are linked to periods before the Globe rules came into effect, which ones you can use for those Pillar 2 calculations. So both on the transitional safe harbor, but also for those full Pillar 2 computations. And this administrative guidance mainly tackles the 9.1.2 of the model rules, which actually states that deferred tax assets that arise from items excluded from the computation of the Globe income or loss under Chapter 3. So that's the chapter that determines the Globe income or loss. So those deferred tax assets must be excluded from the computation of the Pillar 2 ETR if those deferred tax assets were generated in a transaction that takes place after the 30th of November 2021. And the additional administrative guidance actually adds to that article that there were some arrangements after the model rules were published that allowed certain M&E groups to already recognize, for example, certain deferred tax assets that could reverse when the Pillar 2 rules came into effect. And that's a bit what that administrative guidance tries to limit. They identify a number of specific deferred tax assets that upon the Pillar 2 calculation, so both for the safe harbor and also for the Pillar 2 full computations, that you cannot take into account that full reversal of those deferred tax assets, but only take into account a certain part of that deferred tax expense. So as an effect, without those administrative guidance, it can be that a jurisdiction could be, for example, safe harbored, but by eliminating that part of the deferred tax expense, it could be that the jurisdiction would no longer be safe harbored. And on top of that, the same limitation applies to the full Pillar 2 computation.
Okay, so Joni, a small recap. So I think what we're saying is that in principle, the model rules provide that any deferred tax assets which exist at the moment that you enter into Pillar 2 can still be used or still be taken into account for the calculation, of the Pillar 2. That's the famous Article 9.1. And then there are limitations to this general principle that deferred tax assets disclosed or recognized can be used. And one of them was indeed the limitation 9.1.2 that certain deferred tax assets which relate to items excluded in Chapter 3 cannot be used anymore. Is that a good understanding that I have? And this guidance basically now clarifies or goes further on this point 9.1.2, right?
Yeah, exactly, Peter. It goes indeed one step further to further describe which items should be excluded from the deferred tax assets that you take into account.
Okay, and maybe can we give an example of that, Yoni? So, if I think we can have a couple of situations, right? You could have a deferred tax asset relating to a transaction before 30 November 2021 or after November 2021. I think that's a big difference in the application of the rules.
Yes, Peter, exactly. So that cutoff date of the 30th of November is exactly what happened before that date. So before the model rules were published, those are left as it is. So those are not subject to a limitation. It's for a transaction that happened after the 30th of November 2021. That could, for example, create a deferred tax asset. Then that reversal cannot be considered in the calculations. And this can be, for example, a certain tax credit or a tax relief that was granted by the government where a deferred tax asset was booked and will be reversed during the Pillar 2 period. But this reversal will then be limited according to that new guidance.
Okay, that is far going. I think this goes further than the literal reading of the Article 9.1.2, I think. And I think it's very clear that this is a reaction probably to certain countries or certain situations that occurred, which I think by the OECD were found unfavorable for the Pillar 2 rules. So these rules goes beyond the initial rules. Do you think this means that this needs additional legislative translation? For instance, in Belgium, Yoni, we have the Pillar 2 rules since enacted already since 24. The rules are in the law. Now this additional guidance is coming. This would require an additional legislation in Belgium, I think.
Yes, I think so too, Peter, that this will require additional legislation and also some clarifications. As you can see, that additional guidance is again quite broadly written. There are a lot of items that could fall under that. So I think the guidance targets certain very specific situations to prevent certain abuse, for example, but also genuine investments can fall under that. So I think for Belgium, it will be particularly important to clarify that when implementing those new guidance in the legislation.
Okay. Yeah. Okay, I think the clear action here for the audience should be to look into this suspected period, 30 November 2021 and later, any specific transactions that happened or rulings that were concluded or certain countries which didn't have corporate tax rules but introduced corporate tax rules after that date. It's important to look into your deferred tax asset position because you may be required to make specific corrections to the transitional safe harbor calculation or even the Pillar 2 calculation. So this is important, and this will be, I think, very complex because it will require changes in the national legislation in many countries to enact this additional guidance. So it's a very important one, I think. Okay, but that's good for this point. There were some other points as well in the guidance. I think there were also some lists included, as you mentioned, on which countries are now qualifying or have a qualifying QDMTT or qualifying income inclusion rule. So Yoni, is this important? Maybe start with that question. Do you think this is important, this qualification for Pillar 2?
Yes, absolutely. I think it's very important to have at least a bit of certainty on which legislations in each jurisdiction, whether it is sufficiently qualifying, particularly for the QDMTT safe harbor. So maybe for the audience, a quick recap. The QDMTT is the qualified domestic minimum top-up tax. So basically, the Pillar 2 computation in one jurisdiction where a top-up tax is paid locally to the local tax authorities. We also have it in Belgium. So if a top-up tax arises for the Belgian entities, it's paid locally. According to the order of the rules, a second step would be to compute the top-up tax according to the full rules and according to the income inclusion rule or the undertaxed profits rule. Now, if this QDMTT legislation is sufficiently qualifying and a QDMTT safe harbor is implemented, it basically means that you should not make that second calculation and you can just do the QDMTT computation and stop there. And now it's important because we have the list of the jurisdictions that have such a qualifying QDMTT. So it means that if a multinational group is present, for example, in Belgium, then no second-tier calculation should be performed to compute any additional top-up tax at the level, for example, of the ultimate parent entity.
Yeah, so having a qualifying set of rules in your country is extremely important. That's very clear. I was a bit surprised, Evie, and I know you also monitor the Pillar 2 enactment in various countries closely. I was a bit surprised that the list was so short. There were something like 20-ish countries only included. Was this also your expectation, such a short list, Evie?
Well, no, it was not necessarily my expectation, Peter, because we know that there are a number of other territories that have draft or final legislation already. Maybe to clarify that for the audience, and also the document released by the OECD clearly states this, it has to do with the review process. There are clearly a number of territories that have not finalized their review process, didn't get into their review process timely to be included in this batch of territories that are added to the list. So it's quite clear that you can still do that and that it's not as of the date that the review process has been finalized and you're considered as qualifying. That your QDMTT is necessarily qualifying, so you can go back. So I would expect that this list grows over time, Peter, and my understanding is also that there will be regular updates of that list. So clearly something to keep an eye on and see how things evolve, because this will impact your actual work to be done once you start the compliance process for your Globe Information Return, basically your Pillar 2 return. I will say that there were a number of territories on the list that I maybe not initially expected, like Barbados and Switzerland, but it's, again, keep an eye on the list. It's not the standard list you would expect, and it will increase going forward.
Okay, no, very clear. This was also, I think, a list based on the self-review. So it will also be interesting then to see when the OECD actually starts with their review. So apparently within 2 years after your self-review, the OECD will come in and do a full check of the qualification of the rules. So also that will be an interesting thing to monitor, I think. Okay, so we had the guidance on the deferred taxes that Joni explained. We have this list of what is a qualifying country and not for Pillar 2. Now, of course, there were two other elements in the package. One was a new Globe Information Return. As Joni explained, OECD has published a complete template of how this information return, this tax return for Pillar 2 can look like. Now, this was not the first version that the OECD published. Another version was published already in 2023. But as we indicated, some additional guidance has come in the past year. And so there was a need for a new and an update of the Globe Information Return. And this new return, for instance, has additional data fields to cover the guidance, for example, of last year in June in 24, where there were specific rules regarding intangibles and how you can deal with deferred tax liabilities relating to intangibles. So all of this required additional data points, and this is now a new updated global information return. So that was another important part. And a fourth part that Joni also mentioned is the Multilateral Competent Authority Agreement. So a big concern with Pillar 2 is that taxpayers will be required to file tax returns in every country with all the same data effectively. So the answer of the OECD to that is to publish this global information return, to ensure that taxpayers file this global information return in one country, typically the country of the ultimate parent entity, and that then the tax administration, the competent authorities of the respective countries, exchange the necessary information from that global information return based on a need-to-know basis, where information is shared depending on the information that is needed to be shared for a certain country, depending on the rules, whether they have Pillar 2 rules or not, etc. Now, to enable this, you need a legal framework, and this legal framework is now published. It's a Multilateral Competent Authority Agreement, so it's basically an agreement setting out how this exchange of information will happen between the participants under Pillar 2. It also contains, for instance, a letter that can be signed by the country to step into the Multi-Competent Authority Agreement. So that's a fourth block, and I think on this, the Global Information Return and this competent authority agreement, we will see a lot of movement in the coming months as countries will have to step in, sign up for the compliance and for the exchange of information. So yeah, an interesting package, I think, 4 important blocks there. We have seen in the past years regular publications of guidance. Evie, do you think we should expect then in the coming months some more updates, because we were still waiting for permanent safe harbors, some other guidance? Is that to be expected soon, you think?
I think you're very timely with your question, Pieter, given Trump's inauguration speech yesterday. Now, that being said, we already knew upfront that it would take a while before any additional guidance would be able to be published, because obviously the US has some time to appoint a new representative, or at least make sure that the representatives that are there can stay in place. So it was already announced before the 20th of January that we shouldn't count on any additional guidance from the OECD related to the Pillar project in the short term, given that change at the level of the US. Now, yesterday, obviously, the inauguration speech was given, but also simultaneously at the same time, a number of documents were published, and one of them was a letter to the OECD from the Trump administration, so an executive order linked to the global tax deal. So Pillar 2 and also Pillar 1. In a nutshell, Pieter, the US has made it very clear that whatever was decided by the previous administration, so the Biden administration, as part of the Pillar 2 deal does not have direct effect in the US, that an act of Congress is needed to implement it into legislation. And secondly, it also said that it would meticulously look into whether the national sovereignty in terms of taxes of the US is breached, whether tax treaties are breached, and that they would take protective / retaliatory measures against jurisdictions that go beyond their taxing rights. So in a nutshell, Pieter, do I think additional guidance is forthcoming soon? No, because I think there will also be a political discussion on the UTPR in Pillar 2, because although the new Treasury Secretary has said that they are against Pillar 2 and the further implementation, I think we all know that the first thing they will try to attack is the UTPR, where basically any of the subsidiaries can tax the US if they don't meet the 15% minimum taxation on the globe. So I think more political discussion before we can expect something from the OECD in terms of guidance.
Yeah, thank you, Evie. I think that's Yeah, very clear. So it does not mean, just for clarity to the audience, of course, that the Pillar 2 rules would not apply. Of course, they are there. They are enacted in many countries. But I guess indeed, in terms of guidance, etc., that what's on the table today is what we have, and that's what we will have to deal with in the coming months when compliance kicks in for Pillar 2. And a very interesting dynamic. I'm sure much more will come, and you will be in this podcast to talk about that at the right time in the interaction with the US and tax policy there. Okay, I think that was a good short update for the audience, I guess. So, publication of OECD guidance for important blocks. I think, a couple of action points, I think, for governments out of this guidance, the global information return, the exchange of information. That's something that our governments will have to work with, but also some action points, I think, for you, for the audience as taxpayers. Look into the deferred tax assets. There could be specific transactions not intended to be there for Pillar 2, but just as a consequence, there could be an impact from Pillar 2 on transactions that happened after 30 November 2021, and that resulted in deferred tax assets for liabilities. I think that's a very important consideration and attention point. And with that, I would like to thank you, Joni, Evi, for joining me in the podcast. And I'm sure we'll hear much more about the topic of Pillar 2 and the US policy, of course, as well. Thank you to the audience for tuning in, and hopefully to see you in the next episode. Bye.